Hey, Paul Morrow here. Welcome back. Smart Financial. Please go ahead and subscribe if you want to stay in touch and stay up to date on the things that we're doing. Very happy to report that, my first book, Smart Financial Grandparenting, is having a great run. And the new book, Smart Financial Longevity, is out. The third one is in process, and it'll be out this summer, Smart Financial Wealth Building. Right? And if you join us this spring at some of our live meetings that we're doing from Portland, Maine to Providence, Rhode Island, we'll be happy to sign some books. We're going to give away some books at those meetings. Also, if you join us online, you can download an e-copy of these books if you would like to read them. Let me tell you that after 50 years of running a financial practice, there's a lot of pain associated with a market like this. I'm talking to you in March of 2025. And this happens to be a sort of a timely thing about the market volatility. So let me just explain a little bit about volatility and what you could possibly do about it. First and foremost, yes, the market is down as of year to date about 10%. That's technically what we call a correction. And once it goes down 10%, it's a correction. Once it goes down 20%, it's a bear market. But let's just talk about this and the feeling that you're probably having right now. We've had a great run, by the way. I want to be very specific about those of you that have been investing, especially with our old firm. I ran a financial firm for like 50 years and recently sold out to my younger partners to do this writing and education part. People that were invested for the last 5 years are up almost 100% as of January. Let me say it again. It's been a great 5 years. I mean, double-digit returns. If you're in the market, you've made 75 to 90% of your money. So to give back 10% is not a hardship. Okay? It's a correction. It's a part of volatility. It's a normal part of the investing life. Now, if you're a young person, the definition of a young person, all right, who's someone that's in their startup stages, millennials, I guess we call them nowadays, keep buying. In fact, I'd buy more. Don't get out of the market. Don't get out of the market if you have a 10, 20, 30-year perspective. Just keep buying and keep buying good quality either ETFs or funds that fit into your personal asset allocation and your personal goals. Now, I have to give you my little disclaimer all the time and say, I like financial advisors. I think that you should use financial advisors when you get to a certain number that makes you uncomfortable, But when you're a startup person, you should do it on your own. You should research stocks and funds. You should get into a systematic investment plan and just save. Now, if you get to like 200,000, you start to get nervous, that's the time to start talking to an advisor. Most advisors have a $100,000 minimum anyway, even the lowest end of financial advisors, and a lot of comprehensive firms, have $1 million minimum. So there's a number there around 2 or 250,000 where you might feel like you're so busy in your job and your career, you can't pay attention every day and you could lose money. That's when you should hire an advisor. When you're tapped out in time and frankly, you're getting a little nervous about giving back the money you've made, okay? So if you're a young person, don't sell, buy, okay? If you're one of those Gen Xers, and you're basically not a boomer like me that's already beyond age 65, if you're a Gen Xer and you're an asset allocator and maybe half your money's in the market and half the money is in cash or annuity products or fixed income or whatever, right, then you shouldn't be too concerned. If you're over allocated, that's a mistake of you or you and your advisor. I mean, if you're, approaching retirement at 60 and you're 100% in equities, I think that is a strategic planning mistake, right? And you should think very seriously about how much risk you can take and how long you could postpone your retirement if, the market wasn't favorable to you. It would be a sad thing to have to wait a couple of years for the market to recover, right? So let's talk about the people who've had market shock and maybe they weren't planning on it or they weren't structured properly and you happen to be over 59 and a half years old. And that's the one I want to talk about today. And we're going to call this instant portfolio restoration. Now, this only applies to people over 60. So if you're a young person, I don't want you to even think about your 10% drop. I want you to actually buy more, see if you can increase your 401k contribution, keep investing. You have a long time to invest, right? If also you're between, say, 30 and 60, you should be allocated to a comfort level for you, but you shouldn't be worried about portfolio restoration, right? Because you have lots and lots of time left. However, if you're over 59 and a half years old, right, then there's certain things that you can do which are really not available to young people and not appropriate for young people for portfolio restoration. They're products that will contribute money to your account instantly when you transfer some money to them. And let me just say, they come in a lot of different varieties. You're going to hear a ton of ads about this now that the market is down. There are many brokerage firms, investment firms, insurance companies, and they have all kinds of numbers that they're throwing around. However, I will tell you, it's a very competitive field. And it's a very, very interesting field because if your portfolio is down 10% and you can transfer a chunk of money to one of these brokerages and they add anywhere from 2% to 20% instantly, that's portfolio restoration. Well, let me tell you exactly what we just actually saw a client do this. It was very favorable for them. They were busy, medical professionals. They weren't paying too much attention. All of a sudden, they're 60-something years old. They thought they were going to work forever. They encountered a little bit of health issue with their hands. This particular person was a surgeon. And we just transferred a bunch of their money into one of these products because they got 20% added to their portfolio, kind of wiped out all the losses they had. And that 20% was appropriate because it fit into the needs of their portfolio. So I would say that portfolio restoration for an older person who really doesn't want to wait 4 or 5 or 6 years to recover from a serious portfolio loss is available today. Now, it's going to be more and more competitive. I want you to pay attention to the brokerage firms. They have all kinds of ads running. You're going to hear them on TV, and you have to work with and take the advice of your own personal financial advisor, your investment advisor, your insurance professional, because not all these products are created equal. A lot of them have terrible strings attached to them. Some of them are actually quite negative, in my opinion. Some of them only give you portfolio restoration for income. Now, that's good. It's not a bad thing if you happen to be, let's say, 70 and you're about to take income and someone will add 100 or 200,000 to your account that pays you income. That's a good thing. So there are income restoration products and there's principal restoration products, and they're very, very different. The surgeon I was just talking about, we used a principal restoration product. He moved up $1 million into his Roth account, and they added $200,000 to his account, tax-free inside his Roth. That's a big win. And by the way, it wiped out all of the losses that he had on his portfolio since he found out that he was going to have to retire early. So this was a very big win for him in particular. Now, the second thing about these portfolio restoration products is if you are doing lifetime income planning, which by the way is a big part of my second book on smart longevity planning, it doesn't make any difference how much money you have if you're not getting a check, right? You could have $10 million net worth. If everything that you're in pays you nothing, you are asset rich, income poor, okay? Also, if you happen to be a smart investor and maybe you've got, only 4 or 5 million, but it's paying you 500 grand a year, that is a smart longevity planning portfolio, because income is what drives our lives. Income is what pays for the things that you eat, you wear, pays for high quality food and high quality environment so you can extend your longevity, right? This is a really important thing. So it is appropriate sometimes to get a portfolio restoration income product. And by the way, when I say income product, I mean any type of insured product that pays you 6 or 7 or 8%. That is like a super bond, right? If you normally have $1 million that's paying you 4%, and you can move it somewhere and get 8%, that's a material increase. It's a huge bump. Instead of 40 grand a year, it's 80,000 a year. Folks, that makes a big difference in your retirement life, especially, and most especially, if it's guaranteed income forever. Because if you've read our book on longevity and you follow the things that are in that first couple of chapters on smart financial longevity planning, it's not all about the money. It's about actually the way we're living our life today with technology and medicine advances and, knowledge about exercise and food that's going to push us out to the 90 and 100-year life expectancies. You want income that lasts forever and ever and ever. So if you want portfolio enhancement, now is the time to get it. Now, I don't know how long these things are going to last, by the way. The financial markets are very, very competitive. And you'll notice that they're bidding themselves up. I remember when the first portfolio enhancement product came out, they were offering 1% to transfer your portfolio into this brokerage. That lasted about a month until everybody else caught on. And then the other brokerage firm raised it to 2%. And then another firm raised it to 5%. And then for a while, we were dealing with a maximum of 10%. Now, the portfolio enhancement and the income enhancements are up to about 20%. And when I say 20%, that means instead of getting 5% income on your portfolio, you get 6%. That's a lot. Or in order to get $1 million plus an extra $5,000, you get $1 million plus an extra $200,000. Those are huge, huge enhancements. So every one of these has strings attached to them. They're not all created equal. I want to encourage you strongly to work with and take the advice of your personal financial advisor, your insurance professional, to make sure that you're getting into a product that has strings that aren't negative for you. For some of these products, by the way, that you can take income from them instantly. Otherwise, you have to wait. So I think, again, to go back to my surgeon example, he found out because of his health issue that it was an immediate change of his life. And for him to be able to transfer his account, get instantly endowed with an extra 20% in cash now that he could start drawing on within 12 months, that's very favorable. Anything that you go into that has a long-term wait, it might be okay if you're 50 and you want to restore your portfolio for age 60. But the waiting period is super important. Also, I want to remind you that all these products, a lot of them are backed by the financial strength of insurance companies. Insurance companies have become the preeminent firms in retirement planning and distribution. As you know, if you're familiar with the big telephone company Verizon, they just turned their entire pension plan over to Prudential, along with General Motors and everybody else, because guess what? Insurance companies know how to actuarially calculate lifetime income so that the consumer benefits and they benefit. They are in business to make money. They are not charities, but they have it all figured out. And the reason that you can't beat an insurance company like Prudential, which is a fine company, by the way, the reason you can't beat them is they have a calculation, which is the mortality enhanced rate of return. What that means is if 1,000 people buy these products from them, only 700 of them are going to survive to get the long-term income. 300 of them, 30% of them are going to pass away. Those people who live longer get the benefit of the folks' money that have passed away. That's called a mortality enhanced rate of return. You can't beat it in the bank on your own because it's just you. It's not a pool of people putting money together. If you want to read an interesting chapter of my upcoming book on annuity income calculations, and an old term called tontine, T-O-N-T-I-N-E. Tontine works just like that. The more people that buy, the ones who survive win. The ones who die early support the ones who survive later. So this is just one of the products that's really important right now because the market's down. And I know a lot of you are concerned. If you're a young person, don't be concerned. If you're a midlife person, you might adjust your asset allocation, but don't be too overly concerned. If you're over 60, you're the person that I'm talking to that should be looking at perhaps doing some portfolio restoration for either lifetime income or for a big bump in your principal. So to get more information about this, just stay in touch with us on Smart Financial. If you're going to do portfolio enhancement, number one, you should only do it over 59 and a half or 60 years old. Number two, you should make sure that you do it with a firm that's very financially strong, whether it's a brokerage firm or an insurance firm. It should be super highly rated. Number three, you have a choice of doing income enhancement or principal enhancement. Choose the one that suits your situation best. And number four, be very, very cautious about the strings that are attached and make sure that those strings that are attached are acceptable to you and fit into your portfolio management going long term. So I'm Paul Morrow, and I'm really happy to have you here on the channel with us. Stay in touch with us for more information about Smart Financial and just the art of being smart.